Last class, we started on accounting for inventory, where we were able to explain what accounting for inventory is and the purpose, the procedure, and the necessary documentation that's needed for an organization to have a good record of inventory. And at the end of the class, we were able to also talk about valuation inventory and how we can valuate our inventory, where we're able to use one illustration on how inventory, let me use Trulog so that you can go see, where we're able to talk about the basic rules, where we say inventory are valued at lower of cost and net realizable value. And then we're able to do one example to know how the basic rule of lower of cost and then the net realizable value works. In today's class, we will be moving to another method of inventory evaluation, where I can usually test questions. This particular method is how an organization can value their inventory at the historical cost. And then we have a different method. We have first in, first out, last in, last out, and then we have a weighted average as well. And I'm just going to explain briefly so that we can go directly into the calculation to help us know how each of these valuation costs usually work. If they ask us what is a first in, first out, as the name implied, it means whatever product or whatever purchase or whatever unit an organization brought into their store is what they are going to give out for the productions. So which means if an organization purchase an inventory of 1,000 with the total unit of 10, whenever they want to issue out any of the inventory, they will start with the first one that comes in first. And secondly, okay, we have formula. Then I will not explain the formula now. The formula is just the units. I'll be explaining later. So let me just skip so that I will explain when we are doing the calculation. We will get everything. Last in, last out is just the opposite of first in, first out, which means what comes in last is going to be the first item that an organization will issue out. So though most of organizations don't usually practice this last in, last out, most especially in the manufacturing company, where majority of their inventories have an expiring date. While the last one is weighted average. This is just another valuation method, which is assumed that all units are valued at the current weighted cost per unit. What this one is saying is before you can issue any inventory out, you have to know what is the total unit of the inventory that you have in the store, and then what is the total cost of it as at when you are issuing the inventory out. Okay, this one's supposed to be total costs. Coming, give a minute. Let me total costs. Write this down one will be units. Okay. Now let's proceed to the example of all these things. Then I will be explaining for us to get how the workings are. Now, I don't want to take much of my time to be explaining on the theory. Now, we have talked much about the theory in our last class. Today is just to, give us how the experience of how these things work. Now, this is a question from iCampus question, where I was able to come out with this particular question. And one of the things I'm planning to do is to make sure that at the end of each class or every week, I will be trying to be coming up with some questions where we can be solving it out ourselves to improve our understanding. Now, this is a particular question where I think this question is 2021. So they requires us to do two approach. They ask us to determine the closing value, inventory, and then the value of the material issues as at the end of the June 2019 using first in and then first out method. So we just start, and then I want everyone to pay attention so that we can be on the same page. Now, the requirements, like I usually said, whenever you see any question from the ICANN, please, the first thing you need to do is to go to requirements first, understand what they ask you to do. Then you cannot go back to the questions. Once you're able to know what they require you to do, that will help you to know where you are to start, from. Now, in this question, they ask us to prepare FIVO and LIVO, first in, first out. Then now let's move to the question. They say Koloko Wakama PLC trade in farm feeds. The following information relates to the movement of the inventory for the month of June. So it means all the transactions there are for 1 month, the month of June. And then the first one that we are seeing, which is the date, the unit purchase, and then the cost per unit, it means that is the purchase that this organization make during the month of June. On the 6th, they purchase 20 units of farm products at the cost per unit of 10 naira. While on the 16th, they purchase 15,000 at the cost per unit of 12 naira 5 kobo. The same thing on the 26th, 30,000 units with the cost per unit of 15 naira. Now, the following issues were made to the production floor from the store department. Now, after the organization make all these purchases during the month, now this is how they issue each of the products to the productions department or the production unit. On the 8th of June, they issue 8,000. On the 18th, they issue out 10,000. While on the 24th, 6,000. And then on the 29th of June, 20,000. Now, we have already know what they asked us to do. And then we read the questions. We're able to know where and where we need to start from. from what they purchase, we're able to see the unit price. Now, this unit price is what we are going to use to determine the value of the closing inventory and then the value of the material issue at the end of the June. Now, I'm going to start. Please pay more attention to this. Now, once these kind of questions comes in, okay, let me start. Solution. I believe you can see it very well. If you cannot see it very well, just let me know so that I can zoom it more further. Now, whenever you want to start with any questions, the first thing that you need to do, make sure that you write the name of the company. Writing all these things as well will give you Mark PLC. Now, this is the name of the company. And then you write stock ledger because we are valuing inventory accounts for June. All these transactions are for June 2019. Now we are using FIFO. Okay, we are using FIFO method to determine the cost value. Always make sure that all these things you write them in the exam. You can even writing all these things can give you at least 1 mark. Now, the first thing we need to do, what did they issue out, and then what did they receive? From what they received is where we are going to issue out the each of the purchases from. Now, the first thing that you need to come up with is receipts. You come up with receipts, and then you can also come here too. I want to make sure that you utilize all these issues, and then you come up here and write your balances. So these balances is whatever you are receiving, you purchase, and then once you issue it out, the remaining balance will be on this side. So always make sure that in the exam or this is how you prepare your table. Then dates. That's the number 1 thing. Let me try to run this. Dates. Now here the quantity of the products that you purchase. Here you can put the value. This value is the total value, the quantity multiplied by the unit price. It will give you the value. Then the same thing to the issue. I'm coming, let me use this line so that I can divide, so that I can divide it. Sorry, you come in, please. I want to use this value. I'm coming. What am I doing? What am I doing? I don't know why this is doing, but let me continue. Okay, let me just continue. All right. Now, quantity, the price, the price and then the value. Okay, let me also put the unit price here so that we can both be on the same page where we are solving price. That is the unit price. Now, if you want to start your LIFO, FIFO, and then the weighted average, these are the key things that you need to write first. Once you're able to write this, believe me, the remaining things that you are going to do is just plus and minus. Because once you're able to come up with this table, it is a guide for you to know where and where you need to put each of the units and the price. Each of the units and then the price, then you'll be able to sum it off without having any issue. Okay, now let's go back to the question. Okay, on the June, 6th of June, now you come to this place. I'll be using some functions, so I'll come to this place. On the 6th of June, they purchased 20,000 units at the rate of 10 naira per unit. You know, tell you that they have open inventory. You need to be very careful. But in these questions now, we are not giving open inventory. So in the question where you are not giving open inventory, you just go to the streets and then you pick the first purchase they make during that period. Now, the first period here, which is on the 6th, they purchased 20,000 at the rate of 10 naira. Now you come here, you put 20,000 at the rate of 10 naira. Now we want to get the value. What we just do, multiply the total units with this 10 naira, then you get the total value at the period when they purchase it. Now the question is, did they issue anything out on the day where they purchase these products? Let's check. Now they did not have any issues. It is on 8 where they have issues. Now what we just do, you come to this balance, you just bring your total value here. It means at the end of the period, okay, let me move this, okay, let me move this, so that once we are doing the balance, we can also know what is the total quantity of what we have, to help us know how each of the movements is. Now on the 6th, they purchased 20,000 at the rate of 10 naira. Now we determine the total value, which is 200,000. Then there is no issue on that day. Now it means in the store, they have 20,000 units of products, which value at 200,000. Now you see 20 units value 200,000. Now you come again, you look. Now we do not have any purchase on the 16th. Now let's check the issues. On the 8th of June, they decide to issue out of these particular products. Remember that the method that we are using is first in, first out. It means whatever that comes in first is what we are going to give out first. Now, how much did they, call it please? Okay. How much did they issue? They issue 8,000. Now, this 8,000 that they issue, first in, first out. It means when we are issuing this thing out, we are going to issue it at the price at which they first purchased this product. Now, if you look very well, on the 6th, they purchased 20,000 at the rate of 10. And then on the 8th, they are issuing out 8,000 from this 20,000. Now, how much did they purchase this product? They purchased this product at the rate of 10 naira. What are you going to do? Just come here, write the 10 naira, which is the rate. Then you multiply it so that you can get the total value of what this product they issue to their production department, to help you to get the total value. Now it means they issue out 8,000 units at the rate of 10 naira, which value 80,000. First thing first, I'll say whatever that comes in first is what we are going to give out first with the purchasing price. I hope we are on the same page. Remember that at the end of the 6th, they close with 20,000. Now, after they issue out 8,000, what is going to remain? It's going to remain what they have in the balance, then minus what they issue out. Now it's going to remain 12,000 units of these products. Now, how are we going to get the value? Remember, we are still maintaining this 10 naira because that is the value of what they purchase it at the first place. Now, what we are just going to do is 12,000 units quantity of these products multiplied by the price they purchase it. Now, it means as at on the 8th that they issue out 8,000, what is remaining for them in the store is 12,000 quantity of this product at the value of 120,000. I want to believe we are getting it. Whenever you have any question, just please unmute your mic and ask the question so that we can both be on the same page. Remember the method we are using here.
Sorry, sir. Can you hear me?
Okay. Continue. You want to ask question?
Okay. So I'm trying to see that 12,000. Can you just take from that part again? Like I want to understand from that part.
Okay, where the 12,000 come from?
Yeah.
Okay. Thank you. Now, remember. Please unmute your mic, please. I didn't mute your mic, sorry. Now, remember on the 6th, they purchased 20,000 units of this product. And then at the rate of 10 naira, which the total value is 200,000. On that 6th of June, they did not issue out any products, which means what the company will be having in the stock is still going to be the same 20,000 with the value of 200,000. Now, on the 8th, that is when they decide to issue out to the production department. They issue out 8,000 of this quantity of product that they have in their stock. You know, just plus or minus. You have 20,000 of products in your shop, and then you sell out or you issue out 8,000. If you minus 8,000 from 20,000 that you have in the stock, how many is going to remain? It's going to remain 12,000 units. But the key point here is we are using FIFO method, which say what comes in first is what we are going to give out first with this same price of what we purchase these things. Now, this is just to help an organization to have a balancing approach of valuing their inventories. You know, so that whatever they buy, if they buy it at 10 naira, they will know that, okay, when we are issuing it out, we are issuing it out at 10 naira. You know, whenever they are determining their costs per unit, or they have already come up with their cost per unit to sell their products, you know, all this is just to help them to monitor on how the value of the inventories is being going from the purchasing level to when they are issuing it out. You know, they will have the ledger. So in this case, they purchased 20,000, they issue out 8,000. It's remaining 10,000, it's remaining 12,000 units for them in the store with the value of 120. How do we get this 120? Remember, the purchasing price per unit is 10 naira, which means we are still within the range of what we purchase at the 10 naira is what we are still going. It's that same product that we are still issuing out. Then we still need to maintain the unit price of what we purchase this product. I believe you get the answer very well, the explanation very well. Now let's move to the next step. Now on the 16th, they decide to purchase another product. Okay, did anyone unmute?
No, I wanted to say I got you. I got you.
All right. Please mute the mic so that. So on the 16th of June, this Wakama PLC decided to purchase another inventories, another materials into their stock. But at this time, the price, maybe they are purchasing a different product or they are purchasing these same products. But what matter here is the price increases to 12 naira 5 kobo. Now you will now come to your solution table on dates, just on the 16th. How much did they purchase? What is the quantity of what they purchase? 15,000 units. But at what rate did they purchase each of these products? At 12 naira 5 kobo. Now, what are we going to do? You have 12,000 in the store before. You purchase another 15,000. So how many quantity of this product that you are having in the store now? You need to add 12,000 units of what you have left. Then you will now add the one you just purchased on the 16th. You add it together. It means when you check your store department now, you are expected to have 27 units of this particular product. 27 units of this particular product. Now I'll make this one. We're supposed to multiply this so that we can get the total value. Multiply by 12.5. Now, let me see if I can. Let me see. Out HK. All right. Good. Let me reduce this. Okay. Now, okay, this one I'll please give me a few minutes. Let me return this particular one back to 12.5. Okay. Now you can see now that the value of what they purchased on the 16th is 187,500. Remember, we have added what they have in the store. We had it together with what they just purchased. Now, very simple. What are you going to do? Now, for you to get the total value of your product. Remember, the 12,000 that they have in the store before value 120,000. Then the total of what they just purchased now is 187,500. You had the two together. You had the two together. It's going to give you 307,500. The initial what you have in your store is 12,000 quantity with the total value of 120,000. Then on the 16th, you decided to add some units to it by purchasing 15,000, which when you purchase it, you were able to pay 187,500 for the product. Then you now add what you purchased to what you have already have in your store. You know, just like plus or minus. Now you own a soft drink store. You have 5 pack of Coke in the store that value 20,000. And then the next day you decided to add another 5 to it, to 5 that you have before. Now it's going to make 10 pack of that Coke that you have in your store. But remember, the 5 that you have before value 20,000. And then the one that you purchased the next day value 25,000. When you are determining the total price or total value of the Coke that you have in your store now, you have to add that 20,000 with the 25,000 of the one you just purchased. It means the value of what you have in your store is 45,000. Now that's the same thing that happened in this scenario now. 120,000 in your store before the value, and then you purchase 185,000. Now let's go to the questions. Now we do not have any purchase still on the 26th. But before that 26th, we were able to issue out some units to production department, for them to continue their production. On the 18th, we issue out 10,000. On the 24th, we issue out 6,000. Now let's come to these dates. On the 18th, we issue out 10,000. On the 18th, we issue out 10,000. Now, this is where little confusion usually come out. Always remember the formula, the method that they ask you to use. They ask us to use first in, first out. It means we need to exhaust the product that we have in our store before we now consider any new one that we purchase. You know, like I mentioned, this kind of scenario usually occur whenever you are in a production department or in an organization where so most majority of the materials have a short life span. You know, they need to utilize what they have before they can continue using the new one. Now, first thing first, I'll say we need to exhaust what we have in the store before, even though we continue buying. But those old stock, we need to issue them out before. We need to issue them out before we now continue to consider the new one. Now, the question here is, which store do we still have? Which material do we still have in store? Remember, on the 6th, we purchased 20. On the 8th, we issue out 8,000. It means from our old stock, we still have 12,000 quantity of the old stock. Even though on the 16th, we purchased another 15,000. We are not going to consider the new one that we just purchased. We still need to issue out from the old stock. Now, what is the price per unit of the old stock? Is 10,000. Is 10 naira per unit. And then we are issuing out 10,000 from the 12,000 of the old stock. Now, just multiply this so that you can get the value of what you are issuing out. Now, it means from the old stock now that we have 12,000, we issue out 10,000 at the rate of what we purchase, which is 10 naira. It means the value of what we are issuing out from our old stock now is 100,000. It means from our old stock now, we still have 2,000 units remaining. From the 12,000, we issue out we issue out 10,000 on the 18th. From 12,000, we issue out 10,000. It means we still have some unit left that we have not issued out. So what we are going to do in this scenario is remember, is still remaining 2,000, and then from that 2,000 we had another 15,000 to it. So just do this, just understand the approach that I'm using. Now it means we left with 17,000 of these products now. Now what are you going to do? You know, to get the total balance? Don't stress yourself anymore. The closing balance as at the closing period minus the value of what you issue out will give you your closing balance. It means in our store now, we are having 17,000 units, which value are 207,500. You might be worried, how do we come up with these 207,000? Simple. Remember that from the old stock, we still left with 200. I will say with 2,000 units. Just multiply it. Sorry, just do it like I just want to show us how the value of this 207 is. Just multiply 2,000 units that is remaining after we have issued out 10,000. Multiply by 10 naira that they purchase it, which is the old stock. Now it means we are still left from the old stock. We still left with 20,000. Then what we purchase, our new product that we have not touched, is 187,000. Now, if we decide to add these two together, this plus this, now it's going to give us 207,500. That is how we arrive at that 207,500. Please, I'm taking my time so that we can understand all these things. Now, on the 24th, they issue out 6,000. Now come to this place. 24, they issue out 6,000. Now they issue out 6,000. Just come here, 6,000 units. Remember, this is where you have some little calculation to carry out. Some little calculations to carry out. Now, our old stock still remain 2,000 units with the units units per price of 10 naira. And then we on the 24th of June, we are issuing out 6,000. First thing first, so we need to consider all the old stock first before we consider the new stock. Now, but remember, from the old stock, we still left with 2,000. It means we need to consider the first 2,000 first. Now, what I will just do here, let me put the 6,000 down here. 6,000 down here. Now, this is what we want to issue, 6,000. Old stock, we still have 2,000 units. After we issue out this 2,000 units, it means we have exhausted our old stock. We don't have any old stock again, apart from the new one that we purchases on the 16th. Now, remember, the price of the old stock still remains 10 naira. The price of the old stock still remains 10 naira. We are issuing out the last one now. 2,000 multiplied by 10 naira, it's give us 20,000. Now, from the 6,000 units that they asked us to issue out on the 24th, we have issued out 2,000. It's remaining 4,000 now. Now, how do we arrive 4,000? This minus this give us 4,000. It means the total of what we are issuing out minus the old stock of 2,000. The one that we have not issued out now is 4,000. Now we have exhausted the old stock. It's left with the material that we purchased, or the quantity of our material that we purchased on the 16th. Now, what are we going to do? Very simple. Remember, on the 16th, we purchased 15,000 with the rate of 12 naira 5 kobo. Now, we now want to consider, after we have exhausted the one we purchased on the 6th, what is remaining in our store now is the one we purchased on the 16th of June, which is 15,000 units of this product at the rate of this, with value of this. Now we need to issue out 4,000 from 15,000. At what rate? At the rate of 10 naira, 12 naira, 15 kobo. 12 naira, 15 kobo. Let me so that I can show the 12 naira, 15 kobo. Now 12 naira, 15 kobo. Now, what are you going to do now for you to get the value of what you issue out from the 15,000? Now, remember, they asked us to issue out 6,000. The method that we are using, first thing first, I say we should all consider the old stock first. Then we can now consider the new stock. Now, we have issued out everything that we have in the stock for the old stock. We have issued it out. The one that we are issuing out now is from the one we purchased on the 16th. Now, for us to get the total value of what we issue out on the 16th, on the 24th, the 20,000 for the 2,000 units, and then the 50,000 for the 4,000 units. It means what the total value of this 6,000 quantity of product that we are, of the material that we are issuing out, it's worth 70,000. It's worth 70,000. Now remember, from our closing balance in the store, what we have is 17,000. And then now from the 17,000 now, we issue out 6,000. What we are just going to do, the one we have in the stock minus the one we just issue out. Now it means in our store presently now, the total value of what we are having is 12,000 units. I believe we are getting this is 12,000 units. 12,000 units. That is what we have left in the stock. We have considered all the old stock now. Now, how are we going to ascertain the value of what's the quantity of the product that we have in the stock? Now, this is the old value that we have in the stock. and then from it we're able to issue out the goods that worth 70,000. Then what is going to remain is going to remain 137,500. I want to believe you are all with your calculator and then you are following me as I'm doing it. Now, what we have in the store is 11,000 value at 137,500. Remember, we have.
So,
Okay. You want
sorry,
someone have a question?
yeah, I'm supposed to take you back, so, but on my screen, I'm using that
Please,
2,000.
the audible, please. I hardly hear you.
Yes,
The network is great. I can't hear you. Can you please be more audible? You know, continue, please. I'm still finding it difficult to hear you. Let's just continue, then you can ask the question. Maybe when the network is good. I don't know, maybe it's from your side or it's from my own side. But can everybody hear me clearly so that I can be sure that we're on the same page? Please, just confirm you can hear me clearly. All right. The person that want to ask question, you can go on if you can, if he just maybe if I can hear you. Okay. Hope this process that we just did now, we are all on the same page. If you did not get, please ask question before we proceed. All right. I want to believe. Please, depending on ask question, maybe later just ask the question so that we can finish this and then we can do another one. Now let's look again now. On the 26th of June, that is when they decided to purchase another product because they noticed that their their materials in the store is going down, and then maybe due to the demand from their customer, you know, they have to reorder the product so that they can fill their stock. Now on the 26th, they decided to purchase another product. You know, they decided to add more to what they have before in the store. Now they purchased 30,000 units. Now, as you can see now, the price per unit continue to rise. You know, on the 26th now, they purchased 30,000 units, and then at the rate of 15 naira per unit. At the rate of 15 naira per unit. Now, please unmute your mic, please. At the rate of 15 naira. Who is that? Unmute your mic. Danny, it seems like you are the one that your mic is on. Please unmute the mic, please. Okay. Now let me continue. Okay. Now on the 26th, they purchased 30,000 units at the rate of 15 naira per unit this time around. At the rate of 15 naira per unit. Now, how are we going to get the value? You know, how to get the value? We usually multiply the total unit of what they get multiplied by the rate. Now, this is the value of what they purchase now on the 26th. Now we come to this place. What is the total quantity of what we have in store after they decide to have another 30,000 units? Now the whole stock, which is the 11,000 units plus 30,000 that they just brought into the stock. It means if we check their store now, okay. Someone drop a question. Okay. My question is directly from the okay. Now let me explain from that side. I think this side might be confusing you people a lot. Now, remember this method. The one thing that you need to remember is what method did they ask us to use? Now, this is from the requirement. Use first in, first out. First in, first out approach say consider all the product that you have in stock first, regardless of regardless of the one that you are bringing in. Consider use all the one you have in your stock first before you consider the new one. That is what the FIFO is saying. And then they ask us to use FIFO and LIFO. But the one we are using here now is FIFO. It means we need to consider everything that we have in stock first before we can consider the new stock. On the 24th, they asked us to issue 6,000 units out. But from the old stock, we are still having 2,000 units out after we have already issued out these 10,000 from the old 12,000. But before we can issue out the total of these 6,000, we need to consider the remaining one that we have left in the stock, the whole one, before we purchase the one on the 16th. The whole stock, we still have 2,000 units remaining with the purchasing price per unit of 10 naira. We need to exhaust it. We need to make sure that we issue everything out before we now consider the old one, the new one, sorry. So that is the reason why I have to put 2,000 here to exhaust the old one. Then we now choose, we now pick 4,000 from the 15,000, which is the new one. So I believe you want to get, so I don't want to waste much of the time. Now, on the 26th, they had another 30,000, and in their stock, they are having 11,000 before. Now, it means the 30,000 unit that they brought into the stock, the old one now will now be 41,000. But what is the total value of what they are having in the stock? Now, the total of the old one is 137,500, with the one they just purchased, which is 140,000. 140,000. Okay, I think this is what I will be doing. This particular one, which is for the old one, is at the rate of 12 naira 5 kobo, because we have exhausted the previous old one. So the one that is remaining is from this 15,000, and we purchase it at the rate of 12 naira 5 kobo. So it means everything that we old one that we have in stock, this is the price per unit. Now let's now check when they issue. On the 29th of June, they decide to issue out another one. They decided to issue out 20,000 units. Now you come to this place on the 29th, they decide to issue out. Now come to your issue column. Remember, we have receipt column and then issue column, 20,000. Now this is another place that we need to do some breakdown on how this thing is. Our old stock that we have left in the store before units is 11,000 units, and each of it is valued at 12 naira 5 kobo. Now you don't need to stress yourself. Just put 11,000 units, because you need to consider the old one. This on the method. Consider all the old one that you purchased. Now we want to issue out 20,000, but we need to push out all the 12,000 that we have in the store before, or the 11,000 that we have in the store before. And at what rate is this old one value? 5 kobo. Okay. This is what I will do. 12 naira 5 kobo. Okay, I think I'm putting it in the wrong this thing. All right, we want to issue out 20,000. Now in the store before we are having 12, we are having 11,000. At what rate? At 12 naira 5 kobo. 12 naira 5 kobo. So how are we going to get the total value? You know, in the exam, once you're able to know the value, just bring it direct. You know, we can bring this 137,500, or you decide to multiply this 11,000 multiplied by the unit price. It's still going to give you the same thing. So it means we first issue out all the old stores. In the store now, we do not have any old product again, apart from the one that we purchased on the 26th. Now, on the 29th that they asked us to issue 20,000, we have already considered the old one, which is 11,000. Now, what is now remaining for us to issue from the new store? Now, it means for us to balance all these 20,000 that we requested to issue out, we need to issue out another 9,000 to complete the total 20 units of the materials that they asked us to issue out. And what we have left in the store is the one we purchased on the 26th, which is the 30,000 units at the rate of 15 naira. What are you going to do? Issue out the 9,000 at the rate of 15 naira. Then you get your total value, 9,000 units multiplied by the 15 naira. Now it's 130,000. So it means the value of what the 20,000 that we are issuing out on the 29th is 272,500 naira. 272,500 naira. Now, how much are we going to have remaining in our balance? It means at the end of the period now, at the end of the period, the closing balance. Now you now come here, the closing balance for the period, or for June, since it is month of June. The closing balance for the month of June now is 41,000 minus 20,000 that we issue out. Now, what is the total value? Remember that the whole one that value of 12 naira 5 kobo, we have issued it out. Or the one that is remaining in the store, in the one that we purchased on the 26th, which is at the rate of 15 naira. Now, it's two methods you can use. It's either you do this one, the total value of what you have in the store before minus the one you issue out is going to give you this value. Or you decided to use this method. What you have remaining multiplies it is only the one we purchased on the 26th that is remaining, multiplied by the unit price that you purchase it, which is 15 naira. You are still going to arrive at the same thing. So now it means at the end of the period, the company were able to close with 21,000 units of a product that value at 315,000. Now, this is what they asked us to do. This is the closing balance. It means from the question number A, Roman figure 1, we are through with the questions. Once you are able to answer this one very well, then you have gotten your full 7 mark. So it's being expected once you know what you are doing. Okay, someone is raising up his hand. Okay, unmute and ask questions.
So I don't know if it is only me. I can't see your screen. So I don't know whether it's my network.
Please, so another person should confirm. Can you see the screen? Can you all see my screen, please?
Yes, I can see your screen.
Please check again. Check again why you are unable to see the screen, please.
Okay, thank you, sir.
All right, please. Can you see it now? Okay. Now, once you're able to do this, within 10 minutes or maximum of 15 minutes, 15 minutes is too much. Once you know what you are doing, within 10 minutes, you can finish these things on your own. Just understand the basic approach. The FIVOs said we need to consider our old stock before the new one. regardless of what we are issuing out. Consider all what you have and then maintain the price of the old stock. The issue out your old products. Issue out your old products. Now, I want to try one trick. Now, this one by getting the total value of what we issue out. Let me then so that we can see if we are still going to arrive at this 135. Now we first issue out 80,000, then we issue out 100,000, then we issue out 70,000, then we issue out last 272,500. Now this is the total value of the product that we issue out. Total value of the products that we issue out. Now, what is the total value of the products that we purchase? 200,000 and the first one, 187,500, and then the last one is a 450,000. Now, this is the total of what we purchase. This is the total of what we issue out. It means in our store. Now, let me now check if we are still going to line up. Yes. Now, as you can see, now we see arrive at the same value. We still arrive at the same value. The reason why I did this is if you want to confirm that what you did
It's correct.
is correct, this is the simple way that you can know. But in the exam, if you now check the total value of what you purchase, and then the total value of what you issue out, and it's not giving you the closing balance value, there's problem somewhere. There's problem somewhere. It means maybe when you are calculating, you have made some little mistakes. So you need to check again if you have the time. But please don't waste your time on question that is confusing. Once you see that, okay, it's taking much of your time, go to another one. But I believe with the approach of this, now you can understand how it is. Please let me plug my guardian so that we can continue. Okay, I'm coming, please. All right. So once you were able to do this, seriously, you are free to go. Now let's move to the second approach. In this one, it's also need us to explain better, because if we do not explain we fast, we might not actually get the basics. And then whenever we are doing it on our own, it might be a little bit confusing. So just remember, first thing first, I'll say, issue out all your old products first, regardless of the time that you are buying the new one. Issue out everything first before you now consider the new one. Now, this is the second method now. This one say last thing first out. Now this is the opposite, like I said earlier. Opposite of first thing first out. In this scenario now, they say even though you have 100 units of products before, consider the one that comes in last. The one that comes in. Now you have 10,000 units before, and then you decide to purchase another 5,000. Consider that 5,000 units before you consider that 10,000. That is the approach. But majority of the organization are not using this method. So now let's just, okay. Now let me copy this and take it down. Let me copy this and take it down. Then and change this very one. We are using last thing first out. Now this is the second method that they ask us to use. Now this is the opposite. And we are still going to use the same questions to solve it, but you need to pay attention to this one. Pay attention to this one so that we can both understand. Now let me copy these two. Let me copy these two and paste it here. Now. Okay. Let me Let me copy this too, because I don't want to take much time here since we'll be focusing on the issue. Okay. I'll make sure that I explain it for us to understand. Let me copy this. Okay. Now come here and paste this. Now, on the 6th, we purchase 20 units. Remember, we at the rate of 10 naira, you know, which value supposed to even bring everything, but let me do it like this. Which value 200,000. This method is different from the first one. This one is a last in, first out. Last in, first out. Now, then I'll come to the question. In the issue, on the 8th, we issue 8,000. On the 8th, we issue 8,000. This is on the 8th. On the 8th, we issue 8,000. 8,000. Now, we do not have opening balance, like I said. In a scenario whereby we have opening balance, you know, in the question, they might give you the one that have opening balance, and you might be a little bit kind of confused whenever you want to treat this kind of thing, because maybe you have not solved anyone that have opening balance before. So then assume that we have opening balance and 200. I'm still going to remove it just for an assumption at the rate of 8 naira. Now the total value now will now be, it will now be this. It means we have 2,000 at the opening balance. The value 16,000 is stored before we purchase another one before we purchase another one on the 6th opening balance. I'm going to remove it because it's not part of the question. I just want to explain opening balance. Now, and this approach says we should consider what comes in last. We should issue what comes in last. Last in, first out. You say, okay, what comes in last is what we are going to issue out first, regardless of what we have in the store before. But the first method says we need to consider what we have in the store before. We now consider the new one. Now, in this scenario now, despite the fact that we have opening balance of 2,000, we are not going to consider it. Because this method did not ask us to consider it. It only asks us to consider we should consider what we purchase last, what we bring to the company last, regardless of what we have in the old store. And then the price of what we bring in last is 10 naira. What are we going to do? We'll now multiply it to get the value. This one multiplied by this, give us this 80,000 naira. Now, how are we going to arrive at our closing balance? Remember, in the store, we still have 2,000. Now, what's very simple thing. Okay, let me put this one here, 20,000. You want the 20,000 that you purchase, and then with the value of 200, the value of 200. Okay, so now for it, okay, this one plus this. Okay, so now in the opening balance, we have 2,000. We have 2,000 units, value is 16,000, and then we purchase another one value 200,000. It means what we have, the total what we have in the store now is 216,000, and this one will be 22,000 because we need to add them together. That is the total value. Now we have in the store 22,000. The new one that we just purchased 20,000 plus the old one. But this method says, despite the fact that we have 2,000 at the store, we need to consider the one that we just purchased first, the one that we purchased last. I hope you are getting it now. So make sure that in the exam, if they give you opening balance, consider the opening balance first. So very important. That is the reason why I decided to bring this one up. So let me just remove it. Let me remove it so that we can continue. Now, from the question, they did not give us opening balance. It means what we purchased on the 16th is what we are still going to issue out. Then we have issue out 8,000. Now, what is remaining for us in the store is going to be 12,000. And then at what value? The total value minus the value of what we issue it out, it will give us this. It means in the store now we have 12,000 quantity or 12,000 quantity of this particular material that we brought to the store at the total value of 120,000. 120,000. Now let's go to the question back. If we have, okay, we do not have anyone apart from the one we purchased on the 16th. Now this is what we purchased on the 16th. Remember, what we purchased on the 16th is at the rate of 12 naira 50 kobo. Now 12 naira 50 kobo is the quantity multiplied by the unit price, give us the total value. Then we come here, the whole stock 12,000 plus the new stock that we purchased. It means in our store now we are going to have 27,000. Now, what is the total value? 120,000 plus the value of what we just purchased is going to give us 307,500 naira. Now, let I go back to the question. On the 18th, we issued out 10,000. On the 18th, we issue out 10,000. Now come here. This is where we have work, 10,000. And the method say we need to consider what we issue out, what we purchased last. You know, the new product that we just bring into the store is the one that we need to issue out first. And then the new product that we bring to the store now is the one at the rate of 15 at 12 naira 5 kobo, 12 naira 50 kobo, sorry, with the total units of 15,000. Remember that in the old stock, we still have 12,000 that we have not touched. But this formula is telling us that what we bring in last, the new product that we bring in is the one that we need to issue out first. So we are not going to consider this 12,000 now. We'll consider our issue from this 15,000. You know, it's the opposite of what we just did. So that is the reason why you need to pay attention whenever you are solving this question. And then what is the unit price of the products that we just purchased that we bring to the store on the 16th? Is 12 naira 50 kobo. Despite the fact that we still have the old stock that we can still use to cover this issue. But this formula says, no, we are not consider the old stock now. We need to consider the new product that we just brought into the store. Now, what is the value? 10,000 multiplied by 12 naira 50 kobo. Now, it gives us 125,000. 125,000. So now this is the value of what we issue out from the new stock that we just bring to the store, which is from the 15,000, and we have issued out 10,000. It means from the 15,000 that we have issued out 10,000, and we have 5,000 units remaining, and we still have 12,000 units remaining from the one we purchased on the 6th. Now, how many units that is remaining for us in the store now? The total that we have in the store before 27 minus the new one, the one we are issuing out now. Now, what we have now is 17,000 of this quantity, this product. Now, how are we going to get the value? This is another work that we need to do. Remember, here, the total value of what we have here is 10 naira per unit. And then when we purchase another one on the 15th at the rate of 12 naira 50 kobo, we had it up together to get this one. And we want to get the total value of this. You need to be very careful. Are you with me? You want to ask a question? Okay, let me continue. Now, it's on two things that you can do. Two things. You can just say this minus this to be on the safer side. You get 182,500. I think it's just the best approach that you can do. But if you want to break it down further, okay, how did you arrive at this 182,000? Very simple. From the old stock, we have 12,000 that value 10 naira. The new stock that we just bring, which is from the on the 16th, that we just issue out 10,000. From the 15,000, we say it's remaining 5,000 at the rate of 12 naira 50 kobo. Now, what are we going to do? Simple. Just multiply this by this. I'm just trying to explain so that we understand how this 182,000 comes in. This one multiplied by this. Now it gives us this. Then you just sum them together. This plus this. Now you can see now 182,500. So I believe that we can get sticks now. Now on the 24th, because our next purchase is on the 26th. Now on the 24th, we issue another one out. On the 24th, we issue out 6,000. We now come here again, 6,000. Okay, no problem. We issue out 6,000. We issue out 6,000. But how are we going to issue out these things? This 6,000. You just write it down here. Because the material that we purchased last, which is 15,000, that we already issue out 10,000, we do not have up to 6,000. Assuming we have up to 6,000, we will just issue out all the 6,000 and consider the price per unit of 12 naira 50 kobo direct. But we do not have up to 6,000. Since we have not bring in any products, we still need to consider what we have in the stock. But how do we consider it? We still have to consider the one that we brought in last, which is from on the 16th. We are sources first. If it is unable to cover the total of what we want to issue, then we can now consider our old stock. Now we want to issue out 6,000. But what is remaining from our last purchase now, after we issue out 10,000, is this 5,000 units. Simple. Just come here, put 5,000. At what rate? Okay, it's supposed to be here. 6,000. Answer this one. 6,000, 5,000. That is what is remaining from this 15,000 after we issue out 10,000. At what rates? 12 naira 5 kobo. Now this one multiplied by this to get the value, multiplied by this to get the value. Now 62,000. It means this 62,000 that I value for the closing balance, closing value of the one we brought in on the 16th, we have exhausted it. But what we are required to issue out is 6,000. And it means the 6,000 unit of products that the production department required to, and we need to issue everything. Now it's remaining 1,000 now. And we have issued out all the material that we purchased last, which is from on the 16th. But all stock that we purchased on the 6th, that we only issue out 8,000, is still remaining 12,000 at the rate of 10 naira per unit. Now we will now issue the remaining 1,000 units out at the rate of 10 naira per unit. Now we say this multiplied by this, it gives us 10,000. So it means from this old stock that is remaining 120,000 of total value, that we have the total quantity of 12,000. We have issued out 1,000 from it. So it will be remaining 11,000. Now you just come here. Sorry. Now we have issued out the total 6,000 units. At what total value? At what total value? What is this? Okay. All right. Now the total value of the 5,000 is 62,500 plus the 10,000. Now it means the total value of this 6,000 that we issue out now is 72,500. Now, what is our closing balance? What do we have left in the store after we have issued out the 6,000? Now, what we have remaining in the store now will now be from the total of the 17,000 that we are able to issue out 5,000 of the one we purchased on the 16th, and then we're able to issue out another 1,000 from the old stock. Now, which the total issue as at 24 is 6,000. Now, it means in our store now, we left with 11,000. This 11,000, what rate are we going to use? We are going to use 10 naira because the 12,000 that we just issue out 1,000 is the old stock that is still remaining now that we have not even touched. Now, it means this 11,000 multiplied by 10 is going to give us 110,000. And then another method that we can do, very simple, the total value of the old stock minus this one that we just issue out, still going to give us the same thing. I believe we are getting it straight. We are getting it. Now, on the 26th, let's check the question. On the 26th, now they now decided to purchase 30,000 at the rate of 15 naira units. You can see it here because I've decided to bring all the total products, total unit they purchase. Now, at what rate? 15 naira. Then what is the total value? This one multiplied by the each unit. It means what they purchase on the 26th, the total value now is 450,000. But what is our total quantity? Old stock, we still have 11,000 plus what we just bought on the 26th, which is 30,000. Now it means in our store now, we have 41,000 units of products presently. 41,000 units of products presently. What is the value? The total value. Now, the total value of the whole stock is 110,000 plus the new one that they just brought into the stock, which value at 450,000. Now, in our store now, we are having 506,000 in the stock. 506,000 in the stock. Now, let us check our last issue. From the question, our last issue was on the 29th of June. We issue out 20,000. Now, as an organization, you need to make sure that you did not run out of products. You need, regardless of how the movement of your production is, always make sure that you have what we call as the other level. Where we should be able to do that in our next class, where we'll be using economy quantity. What is the other level of organization? Our next class we'll talk about it. Now, on the 29th, they decided to issue out 20,000. 20,000. The question here is, what they brought in on the 26th, is it up to 20,000? If the answer is yes, then we issue everything out. If the answer is no, then we issue the one they brought in on the 26th can cover. Then we will now consider the old stock to balance the total issues. But in this scenario now, what they brought into the store on the 26th, and then what they require us to issue out on the 29th, can cover what we brought in on the 26th. So we'll just issue it out total by consider the unit price of what the product that we just brought into the store, which is 15 naira. Despite the fact that we see have for this particular level, last thing first, I say, even though you have 1 million stock in the store, don't consider it first. Consider the last one that the latest one that is just brought into the store. you consider it first. But if when you are considering it, what you want to issue did not meet up with what you just purchased, then that you cannot consider the old one. But in this scenario now, we purchased 30,000 on the 26th, and then on the 29th, we want to issue out 20,000. So very simple, it means it covers everything. So what we do is 20,000 multiplied by the unit price. Now this is the total units, the total value of what we are issuing out. Now we have issued out the total of what they asked us to do on the 29th. What is left in our store now? What is the total unit of what we have in the store? Remember, after we purchased 30,000, we added to 11,000, which give us the 41,000 units that we have in the store as at the close of 26 June. Now on the 29th that we issue out 20,000, we now say, okay, the total of what we have left in the store before, we now issue out. And then on the 29th that we are issuing out 20,000. Bam. We left with 21,000. Now, what is the value of what we have in the store now? The total value minus the value of what you just issue out. Bam. You get what you have in the store. And if you want to confirm, okay, let's say, okay, 26,000. How now? How do we get it? The same approach that we do up here is still what I'm still going to apply here so that we can understand how it goes. Now, the old store, which is the one on the 6th of June, is still remaining 11,000 at the rate of 10 naira. The one we purchased on the 26th, which is 30,000, we were able to issue out 20,000 on the 29th from it, which means it's still remaining 10,000. Now 10,000 at what rate? At the rate of 15 naira, because that is the rate that we purchase it. Now, then I calculate the total value of what we have in stock if it is in line with what we say we have as our total value. Now 10,000 multiplied by the rate of 15 naira. Now we say we have 10,000 plus 150,000. Now, good. It means what we say we have in the store as at the closing balance is still what we have, which is the total unit of 20,000 at the total value of 206,000. Let me shift it down here so that this is our closing balance. This is our closing balance as at June, or for June. We don't have closing balance for closing balance for June. And this is the closing balance for June. Now, the same approach, okay, we say, if you see now, the balance of this one is different from the balance of this one. Now, let us confirm if what we have as the total value is correct. Now, we first issue out the value of 8,000, which is our 8,000 units multiplied by 10,000, 80,000. Then we issue out the total value of 125,000. And then we also issue out 72,500, while our last issue is 300,000. So it means the total issue is 577,500. Why? What is the total of what we purchased? 200,000 plus 187,500 plus 450,000. Now, what we close with is, let's now check the total of what we purchased minus the total of what we issue. Now, good. It means we were on the same line. Immediately you're able to check this and you are having issue. It means what you arrive here is not correct. So even in some cases, it might even have the total distance. But what matter is just make sure that you understand the steps on how each of these things is being done. That is the most important thing. The first question says we should consider first thing first. The second question says we should consider last in, first out. And then where the pathways least 6 factors are considered in this method. This one, I'm going to share it in the group, then you two can answer it. And then I'll try to come up with one related question of FIFO and LIVO so that we can use that one as the practice. Now, the last one that is remaining now, I think maybe we are going to stop. We are going to stop from here. The last one that is remaining now, because this one we cannot rush. We need to pay attention. We cannot rush because in the question they usually test only this one, weighted average cost. It's a little bit complicated. It's not even complicated, just that if you don't understand the process, you won't be able to do it. This one, the last method, is weighted average cost. Now, where we will be using this formula. Let me paste the formula. We'll be using this formula. Okay, we'll be using this. We'll be consider this formula. We'll be using this formula. We'll be using this formula. Okay, we'll be considering this formula. Now, what this formula is saying is the first method that we use, we consider the first in, first out. The second method that we use, we consider the last in, first out. But in this one now is weighted average cost. What does that mean is if we want to determine any value of our balance as at the period of as at the date, or what we are issuing out our products, we need to consider the average cost. And then how can we consider that average cost? Now, I will just this simple approach. Then we'll solve the question next class. And then we'll now solve another question on the EOQ. I think that is the two things that we'll be doing in our next class. Now, let's assume that we purchase, let me read, we purchase 600 units of products at the rate of 10 naira for common purchase, and then the following day we have not issued out, we purchase another one. Maybe let's say we purchase 700 at the rate of 12 naira 8 kobo. Now, what is the value of this first one? This is the total value of what we purchase. And then what is the value of the next one that we purchase? This is the total value of what we purchase. Then let's sum it. Okay, since we have not issued out, our first purchase is 6,240, while our next purchase is 8,960. Okay, what is the total unit of what we have in stock since we have not issued out? This is the total unit of what we have in stock. This is the total unit of what we have in stock. Now, in this scenario now, for us now to now come up with the total closing balance. Now, look at the formula now and say the total cost of the inventory available. What is our total cost of the inventory available? 15,200 divided by the total units of the inventory available. Our total unit of inventory available now is 1,300. Now, for us to now get the weighted average that we are going to issue out our products now, it's now going to be this divided by this. So it means any product that we are going to issue out, we are going to issue it out at 11 naira 69 kobo. 11 naira 69 kobo. Instead of using our normal value of purchasing each of these products, each of these things. You know, that is the differences between those two methods that we test. Because in this one now we are using a weighted average. You have to consider the average cost to issue out your products. We determine the price of the average cost. And then one funnest part is this average cost now that we are going to issue out of our products. Now, if we now multiply it by the total unit of what we have, it's still going to give us the same value of this 15,200. Now, multiply by this. Now, as you can see now, it still gives us the same thing. But in this method now, regardless of what we are issuing out, issue it out at the average costs per unit, not at the price that you bring in the products. Whether the last in or last out, no. Issue it out as the average units. How do you get the average units? What is the value of what you first brought in, and then the second one that you brought in, you add the two together. Get your total value. Then divide the value by the total unit that you have. It's going to give you the average cost per unit that you are going to issue out a product. Now let's assume that we issue out now. We issue out, we issue out 400. Now, what price are we going to use? We cannot use 8, we cannot use 12 naira 8 kobo, we cannot use 10 naira 4 kobo. We are going to use the average price per unit that we just value now, that we just calculated for now, to issue out this 400. Now, it means this is the total value. Let me reduce this. Let me just bring it to the unit or okay, let me put it into decimal points. Let me put this one into decimal points. Okay, 2 decimal points. Now, it means this is the total value of what we are issuing out. Total value of what we are issuing out, 4,676 kobo. 4,676.92 kobo. Now, how are we going to now get our closing value? You now see this one that we close with minus the one that we just realized we usually do that we did from the last one. Now you want to get the closing value. How are we going to arrive at our closing value? You will just say this. Okay, let me go straight forward. You just say this, the total value of what you have before, which is this, minus the value of what you usually had, like we did in the first one. So it means in the store now, what is remaining for us in the store, the total value is 10,522 kobo, which is equivalent in quantity as 900 units. So this is how the weighted average is being worked, and then this is where we will be stopping so that we can understand it better. I don't want to bombard us with solution with questions so that whenever we are trying to check all these things back, we'll be able to understand the process one after the other. So with the little approach of this weighted average that I just explained, I believe we're able to get the little clue of it. Then in our next class, we'll be treating this question. It's also from ICANN past question, because I want to make sure whenever the example that we are doing, we are making use of the structures of the ICANN so that we can be familiar with how their questions usually come up. This is what we'll be solving next using weighted average. So I'll be stopping, we'll be ending our class here. And anybody that have questions, unmute and ask your questions. From what we have done from the beginning, you can unmute now. Anyone that you do not understand, ask question, whether relating to what we just stated today or from the last class. So just unmute and ask your questions.
Elisa,
All right.
I've been feeling all through. And I've also been writing as you are also showing from the computer, but I got lost. Let me see from that from
The FIVO, the first method.
yes, that one 20,000. I was 30 on my own though, but I hope this video will see that.
Okay, what did you you are writing it as we are doing it, right?
Yes.
Okay, on your own side, what did you get?
No. I was writing according to your writing on the screen, but where I got on how to calculate on my own now was that 2,000. I don't know.
Okay. Let me explain. Let me explain again.
I don't know it's late for everybody, but I don't mind if the video can
okay, no problem. Any question again? Anybody that have any question to ask so that I can answer the questions once and for all. Any question again? Okay. Now I believe the remaining people understand, but for more clarity, let me explain it. Now, one thing you need to understand in this scenario, one thing you need to understand first, which method are they asking us to use? Which method? You know, one thing is calculation is you cannot cram calculations. You can only understand the steps and you understand the basis. You know, some of you that are accounting related students can understand what I mean by that. But for those of us that do not really understand how the accounting approach is, even in your financial accounting, where we have some formula, we have steps that we have to follow. Even though you cram it and you do not understand where and where you need to put the figures, you are still going to get some little difficulty to calculate them. Now, that is the reason why I emphasize from the first, before I started the question, is understand what the question is required of you to do. The question said we should determine the value of the closing inventory and then the value of the material use using FIVO, first in, first out, and using last in, first out. Now, you need to understand what the first in, first out stand for and what the last in, last out stand for. The first in, first out say, regardless of what you are bringing into the store new, make sure that you utilize all your old stock. Utilize all your old stock, regardless of the total of what you are bringing into the store. New, utilize your old stock. You know, majority of organizations that are into maybe manufacturing company, food company, all those things, this is the approach that they are using, first in, first out. You hardly see an organization that use a last in, first out. This approach say what you have in your stock before, use it finish. Why did they ask you to do that? Maybe due to the expiring dates, to avoid being loss of value of some of your inventories. You remember in our last class where we were able to value our cost using cost, lower of cost, and then lower of net realizable value. This is the reason why we are doing such. In order for us to lose the value of some of our stock, we need to utilize them accordingly, using the best approach that an organization can use to make sure that the value of their store are not reducing regardless of how their production level is. Now, on the 18th, that they asked us to on the 18th, they asked us to issue to the production department 10,000. 10,000. Okay, on the 24th, I think that is where we are having issues. On the 24th, they asked the department to issue 6,000. But this approach says we need to consider what we have in the old stock. And then when we are calculating these things, from our old stock, the one that we first bring in, we issue out 8,000 from 20,000. It remains 12,000 in our stock. It remains 12,000 in our stock. And then on the 16th, you can see the dates number from the 8th to on that 16th, we did not issue out anything. But on the 16th, the company decided to add more value, more stock, more materials into their stock. On the 16th, they decided to add another one, which is 15,000 units at the rate of 12 naira 50 kobo, which value this. Now, how are we going to get the total value of what we had in our stock? 12,000, that is what we have before in the store. Then we bring in another 15,000. Just add the two together, it gives us 27,000. The same thing to our total value. Okay, we say the total value of the old stock is 120. And then we had the new value of the new product that we brought to the store together. It gives us 307,500. And then the same thing we issue out on the 18th, we issue out 10,000. And the formula says we need to consider our own stock first. Now, before we consider this 15, we need to consider from this 12,000 that we still have left from the old stock. Now we issue out 12,000, we should have 10,000 from this 12,000 of the old stock. It means from our old stock, which is the one we brought in on the 6th, we still have 2,000 left in the store. We still have 2,000 left in the store, which means any products or any material that want to issue out to production department, we need to consider that 2,000 first before we cannot consider any new one that we brought into the store. Since we have issued out 10,000 from the 12,000, it's remaining 2,000. Now let me do it here. 12,000 minus 10,000 that they issue out. Now it's remaining 2,000. It's remaining 2,000 here. And then our new products now, we are having 15,000. How do we get that 15,000? The 17,000 that is remaining after we issue our 10,000 minus this is okay. Sorry, the 17,000 that the 10,000 that we issue from this 27,000. I'm coming. I want to. Okay, it's going to be 7. Okay, let me just do this approach. The new one that we brought in is 15,000. Okay, good. Now, after we issue our 10,000 from this 27,000 that we said is remaining in store, after we bring in 15,000 and then we add it to this 12,000 to give us 27,000. So it means the new one, which is the total 15,000, we have not touched it. And then the old one still remains 2,000 that we still need to consider regardless of what we are issuing out first. Now, this same 17,000, this is how we arrive at the 17,000 here. The whole stock remaining 2,000, and then the new stock remaining 15,000. Now, on the 24th, now they ask us to issue out 6,000. And this method says we need to consider the whole stock before we now consider what we issue out, what we just bring into the stock. The first thing that we are going to do, we are going to consider this remaining 2,000. Consider this 2,000 that is remaining after you have issued 10,000 from this 12,000. That make it to remain this 2,000. Now, that is how we're able to come up with this 2,000. We say, okay, we say this 2,000 that is remaining after we have issued 10,000 from the 12,000. And then at what price are we going to issue out this 2,000? We purchase this remaining stock that we have in store at the rate of 10 naira on the June. So it means we are still going to issue it out at the rate of this 10 naira. But what the production units need is 6,000. It means we have exhausted all our whole products. Now, the only product that we have left in the store now is 15,000, the one we just brought. Is 15,000. Okay, you forget that I'll link it. It's 15,000, the one we just brought. It means the remaining 4,000 here now. This remaining 4,000 from these 6,000 that we are going to issue. I do have 4,000. The total of what they ask us to issue out minus what's the old stock that we issue out. It's remain 4,000, and then the new stock that we have now is 15,000. It means we are going to remove this 4,000 from this 15,000 at the rate that we purchase it. So that is the reason why we are using this 4,000. You know, you add these two together, giving 6,000, then you multiply it by the price unit, which is this one. So I believe you understand the explanation now very well. So that is all for today. Any question again? Any question? If anyone have any question, if we do not have any question, then we can close for today. So I want to thank everyone for joining again. And then in our next class, we'll be dealing with the weighted average. And then we'll also look at the economy order quantity, EOQ. So those are the two things we are going to look at so that we will make sure that we were able to finish our accounting for inventory in our next class. Then after that one, we will now move to next topic, which is on the accounting for labor. How can we calculate our labor? So that is how we'll be doing it gradually, so that we should be able to make sure that we cover everything before the exam. And then I'm pleading everyone that make sure that you keep on practicing. It's very important. So I'm going to share the solution to the group immediately after the class, and then you can go through it and understand. So good night, everyone, and have a lovely rest. Good night to you all. Bye-bye.